time. Take advantage of this support system. Listening as often as possible will help you to pass your exam and be on your way to success. Basics of insurance. There are many specific terms used in the insurance industry. A brief explanation of some of these terms will help in understanding life insurance. Insurance is the transfer of the possibility of a loss from an individual to an insurance company, who spreads the risk among a large number of individuals. The insurer promises to pay a financial benefit upon the death of the insured. The insurer uses the law of large numbers to predict losses. The law of large numbers states the larger the number of individuals in a group, the more accurately the losses within the group can be predicted. By insuring a large group of individuals who are the same age and gender, the insurer can more accurately predict the death rate of the group and plan for calculating premium cost and paying death benefits. Risk is the term used to describe the chance or uncertainty of loss. In life insurance, this is usually a financial loss due to death. The two types of risk are speculative and pure. Speculative risk is the chance of either a gain or a loss, such as gambling or buying a lottery ticket. Speculative risks are not insurable. Pure risk is a risk that can only suffer a loss. With pure risk, there is no opportunity for a gain. Only pure risks are insurable. A loss is the financial hurt or reduction in value as a result of the risk. With life insurance, this loss is the financial hurt caused by the death of the insured. A peril is the cause of a loss. In the case of life insurance, death is the peril. The death of the insured is what leads to the loss of financial stability. A hazard is any condition or situation that will increase the possibility of a peril occurring. When we view death as the peril, some examples include driving recklessly or refusing to treat a serious health condition. Indemnity means to make whole or to restore a policy owner who has suffered a loss to his or her original financial condition, but not to profit from the loss. The insurer is the company issuing the life insurance policy. A producer or agent is the person who solicits and sells insurance, delivers policies, or collects premiums. The producer represents the insurer. A producer must hold a license in order to conduct business in a particular state. The insured is the person whose life is covered by the insurance policy. The insured may also be the policy owner, since many people buy insurance on themselves. The policy is a legally binding contract between the policy owner and the insurer that provides a benefit in the event of a loss. A policy is referred to as a contract of insurance. Premiums are the payments made to the insurer to keep the policy in force. The beneficiary is the person or persons named in the policy to receive the death benefit when the insured dies. The face amount is the amount that will be paid to a beneficiary upon the death of the insured, or maturity of the policy in some cases. The face amount may also be called the face value, death benefit, or policy proceeds.
Types and classification of insurers. Life insurers may be classified in several different ways, such as how they are formed, their authorization to do business, and where they are located. The two main types of insurers are stock insurers and mutual insurers. Stock insurers are owned by shareholders who buy shares of stock in the company and share in the profits and losses of the company. Stock companies issue non-participating policies, or policies in which the insured does not share in the profits of the company. Mutual insurers are owned by their policy owners. Any earnings not used to pay the expenses of the company are returned to the policy owners as policy dividends. Mutual insurers issue participating policies which pay dividends where there is a surplus of funds. Since the dividends paid by a mutual company are a return of excess premium paid by the policy owners, these dividends are not taxable. Insurers can also be classified by their ability to legally conduct business. An admitted or authorized insurer has complied with the legal and financial requirements to be licensed in a particular state. A non-admitted or unauthorized insurer is not licensed to transact business within that state. The license to conduct business is called a certificate of authority. Insurers can also be classified based on their location. A domestic company is a company incorporated under the laws of the state in which it is located. A foreign company is a company doing business in a state other than the one in which it is incorporated. An alien company is a company incorporated under the laws of a country, state, or territory outside of the United States.
Completing the application, underwriting, and delivering the policy. The process of taking an application, underwriting a policy, and delivering the policy has many steps. Before a life insurance policy can be issued, the potential risk must be reviewed and classified by the insurer. This is done through the process called underwriting. Underwriting is the selection, classification, and rating of risks by an insurance company underwriter who will determine if an applicant is insurable. The premium charged will be based on the classification of the risk. One of the main purposes of underwriting is to protect the insurer against adverse selection. Adverse selection is the tendency of those who are poor risks to buy or continue insurance more so than those who are in good health and do not seek insurance. Insurance company underwriters want to avoid adverse selection. One of the most important factors that must exist at the beginning of the application and underwriting process is insurable interest. Insurable interest means that the person purchasing the policy must be in a position to lose something of financial value if the insured should die. An applicant has insurable interest in his or her own life, but may have an insurable interest in a spouse, child, or parent. Insurable interest may exist between a creditor and a debtor, between an employer and a key employee, or between business partners. Insurable interest must only exist at the time of the application, not at the time of death. Beneficiaries do not have to have an insurable interest in the insured. The process of underwriting begins with the producer, who serves as the field underwriter. As field underwriter, the producer meets with the proposed insured and completes the application. Before completing the application, the producer should work with the client to determine the suitability of products to best meet their needs. This involves the producer asking questions about any current policies or annuities and about the applicant's financial status before making a recommendation. The application is the first and best source of information for the underwriter. It becomes part of the policy contract and is the basis upon which the company will accept or decline the risk. The application consists of 3 parts. Part 1, general information. Part 2, medical history. And Part 3, the agent's report. Part 1 includes general information about the proposed insured, such as name, address, date of birth, marital status, occupation, income, and named beneficiaries. This section also includes details about the type of policy and the amount of coverage being requested. Part 2 contains questions about the proposed insured's current health status, as well as personal and family medical history. Part 3, the agent report, consists of personal observations about the proposed insured made by the producer. It contains questions about the applicant's character and how long the producer has known the applicant. Statements made by an applicant are considered representations. Representations are true and accurate to the best of the applicant's knowledge. A warranty is a statement that is guaranteed to be true in all respects. Statements on life insurance applications are considered to be representations and not warranties. Concealment is the failure to fully disclose all known facts on an application. For example, A proposed insured may not lie when answering one of the medical questions, but might not tell the whole truth. If the concealment is material to the risk, meaning the insurer's decision about coverage would have changed, then the policy may be voided. Most states require that the producer present the applicant with certain documents, including a buyer's guide and a policy summary at the time of application, but no later than the time of policy delivery. A buyer's guide is a generic publication that covers the different types of life insurance in language the average consumer can understand. A policy summary lists specific information about the policy being purchased by the applicant. The applicant may be asked to sign other forms giving the insurer the authority to obtain necessary underwriting information. These required disclosures include medical records authorization, HIPAA disclosures, and AIDS/HIV disclosures. One of the producer's responsibilities at the time of application is to determine if a policy replacement is taking place. Replacement occurs when an existing policy is being lapsed, forfeited, surrendered, terminated, converted to reduced paid-up insurance, or replaced with a new policy. Replacement is not illegal, but is highly regulated to protect the policy owner. If the policy is being replaced, the producer must give the applicant a notice regarding replacement of life insurance. Once the application has been completed and signed by the producer, the applicant, and the insured if different from the applicant, the producer collects the first premium and sends it along with the application to the insurer. This means the producer is a fiduciary, a person in a position of financial trust. If the first premium is collected with the application, a conditional receipt is issued to the insured. A conditional receipt will make the coverage effective on the date of application or the date of medical exam, whichever is later, if the policy is issued as applied for. The purpose of a conditional receipt is to begin coverage before policy delivery. The insurer's underwriter has many sources besides the application from which to obtain underwriting information. The Medical Information Bureau, also known as the MIB, is a nonprofit organization established by insurers to allow member companies to share data on health risks in order to uncover cases of misrepresentation, concealment, or fraud on applications. An insurer may occasionally request an applicant's credit report as part of the underwriting process. All insurers must comply with the Fair Credit Reporting Act, which requires insurance companies to protect the rights of the insured. In order for the insured to obtain a copy of the consumer's credit report, the applicant must be notified in writing that a consumer report is being requested. Every consumer has the right to question the validity and source of any credit information and can request a copy of the report from the credit reporting agency. The underwriter must also determine the applicant's classification as preferred, standard, or substandard. Most applicants are classified as standard risk, which means the applicant is of average health and life expectancy. A preferred risk is in excellent health and will pay a lower premium than a standard risk. A substandard risk represents a higher than average risk because of a health issue such as high blood pressure or a hazardous hobby such as bungee jumping. These applicants are issued rated policies and pay a higher premium than standard risks. If the risk is too great or the applicant is uninsurable, the application will be declined. The frequency of payment is called the premium mode. Premiums may be paid annually, semi-annually, quarterly, or monthly. The more frequently a policy owner pays the premium, the higher the total cost to the policy owner. Once the insurer issues the policy, policy delivery provides the producer the opportunity to further explain the coverage and provisions of the new policy. If the first premium was not collected with the application, the agent may need to obtain a statement of good health from the insured. A statement of good health says that the insured's health has not changed since the time of application. Coverage begins once the insured has the signed statement of good health and paid the first premium.
Types of policies, Part 1. There are several types of life insurance policies, but they generally fall into two categories: term and whole life. Both types offer options based on the different needs of the insured. Term insurance is the most basic form of life insurance. These policies are often referred to as temporary insurance because they offer coverage for a specified period of time and expire at the end of that time. These policies can be for 1, 5, 10, 20, and even 30 years. They pay a death benefit, or mature, only if death occurs during the policy term. Term is the least expensive type of coverage. Term policies do not build cash value. Cash value is a savings feature. The three main types of term insurance are level, decreasing, and increasing. The names of the types refer to the death benefit and not necessarily the premiums. With level term, the face amount or death benefit remains the same for a specified period of time, usually 5, 10, or 20 years, or to a specified age such as 65 or 70. For decreasing term, the face amount decreases each year, but the premiums remain the same. This type is commonly used as protection with a mortgage or loan, since the face amount decreases over the years as the loan balance is paid down. With increasing term, the face amount goes up each year. Increasing term is most often used as a rider to increase coverage on a base policy to offset inflation. Many term policies offer two options at the end of the policy term that can possibly extend the life of the policy, either to renew or convert. A renewable option allows the policy owner to renew the policy before the end of the term without providing proof of insurability. The renewed policy premiums are higher since they are based on the insured's current or attained age. The most basic type of renewable term is annual renewable term, or ART, which renews yearly at a higher premium rate. A convertible policy allows a policy owner to convert or change a term policy to a whole life or permanent plan with no proof of insurability. When a conversion is done, the cost of the new policy will be higher since whole life is more expensive, and the cost is based on the insurer's attained age. A second common type of life insurance is whole life or permanent insurance. A whole life policy provides both a living benefit in the form of a savings element and a death benefit. Most whole life insurance policies have a number of characteristics in common. A whole life policy remains in effect until age 100, as long as the premiums are paid and the policy remains in force. Whole life policies build cash value, which grows tax-deferred or not taxed until the money is withdrawn. If the policy is ever canceled, the cash value is paid to the policy owner. The policy owner can borrow against the cash value of the policy, but must pay interest. A whole life policy matures or endows when the insured reaches age 100. If the insured lives to age 100, the cash value of the policy is paid to the insured. Taxes would be due on any amount that the insured receives in excess of the amount paid into the policy in premiums. Remember that with a whole life policy, the insured will receive either the death benefit or the cash value, but not both. Some types of whole life policies can be categorized by the length of the premium payment period. The most common is straight life, which was covered with the basic characteristics of whole life. The premiums for a straight life policy continue, and the policy remains in force until age 100. This type is often called continuous premium. The second type is limited pay whole life. In this case, premiums are paid for a specified amount of time or to a certain age, but coverage remains in effect to age 100. For example, a 20-year limited pay policy also known as a 20-pay life policy, would be completely paid up after 20 years, but would remain in force to age 100. The shorter the payment period, the higher the premiums. The cash value for limited pay policies also increases at a faster rate for the same reason. The third type of whole life, and the one with the shortest premium payment period, is the single premium policy. The entire premium is paid up front in one lump sum. These policies build cash value immediately. Adjustable life was created to give policy owners the ultimate in policy flexibility. The face amount, premium, and type of insurance can be adjusted to meet the changing needs of the policy owner. The policy owner makes two of the choices, and the insurer makes the third choice. For example, the policy can be converted from term to whole life or whole life to term.
Types of Policies Part 2. A variation on whole life is interest-sensitive whole life. Interest-sensitive policies can earn a higher rate of interest on the cash value than traditional whole life policies. Three types of interest-sensitive whole life are universal, variable, and equity indexed. Universal life is a combination of term life and cash value invested at a guaranteed minimum interest rate. It is considered whole life because it lasts until age 100. The premiums paid are combined with the interest earned to first pay for the insurer's cost of doing business and second, the cost of the term policy. Any money left over becomes the cash value of the policy. Two advantages to a universal life policy are: the insured has the right to adjust the premium and/or the death benefit. Partial surrenders are allowed with no interest charged, but the cash value is reduced. Variable life policies consist of both permanent coverage with a guaranteed minimum death benefit and a cash value invested in common stock. The cash value is not guaranteed because it can go up or down depending on the fluctuations of the stock market. The investments for a variable product must be kept in a separate account by the insurer. Because the money in the separate account is invested in stocks and bonds, FINRA, the Financial Industry Regulatory Authority, and the individual state insurance departments require that an agent selling these products must hold both an insurance license and a securities license. Equity indexed life is whole life insurance that is linked to a public index, such as the S&P 500 or Dow Jones Industrial Average. It has a conservative guaranteed minimum interest rate to guard against downturns in the market. It has the potential to grow faster if the market is doing well. Specialized policies, or combination policies, consist of many of the features we have discussed in term and whole life policies, but they are used for very specific needs. A joint policy covers the lives of two or more people and is often called a first-to-die policy. These policies pay when the first insured dies and then terminate at that point. These are often used as business insurance. A survivorship or last-to-die policy covers two or more and pays only after the second or last insured dies. These are frequently used with large estates for tax purposes, since death benefits are not taxable to the beneficiary. A juvenile life policy is a policy written on the life of a child within certain age limits. The policy owner and beneficiary is usually the child's parent or guardian. Modified endowment contracts, or MECs for short, are whole life policies that have lost the tax advantages of regular life insurance policies. Any policy that grows at a faster rate than a 7-pay whole life policy would be considered a MEC. Withdrawals made from a MEC before age 59.5 are subject to a 10% penalty and income tax. Once a policy becomes a MEC, it will remain a MEC. Group life insurance covers a number of individuals under one policy. Many people have group life through their employers, who are the policy owners. The policy, called the master contract, is issued to the policy owner. The individuals insured under the group policy are each issued a certificate of insurance as evidence of their coverage. The insureds choose their own beneficiaries. Individual underwriting is not required for group insurance. Group insurance costs less than individual insurance because of the reduced adverse selection and reduced administrative costs. A group policy is either contributory or non-contributory. When a plan is contributory, the cost of the coverage is shared between the employer and the employees. At least 75% of eligible employees must be covered. If the plan is non-contributory, the employer must pay all of the premiums and the plan must cover 100% of eligible employees. The group life insurance conversion privilege gives members of a group the opportunity to convert their group coverage to individual coverage without providing evidence of insurability. The individual has 31 days to make an application for an individual policy once the group policy has terminated. The rates for the new individual policy will be the standard individual rates and will be based on the insured's attained age. If an insured dies during the conversion period, the group life policy must pay the death benefit even if no individual policy has been applied for at the time of death. A unique form of group insurance is credit life. Credit insurance is life insurance issued on individuals who owe money. It guarantees that if the individual becomes disabled or dies, the balance of the debt will be paid. The amount of the insurance coverage cannot exceed the amount of the debt. Credit life is often written as decreasing term, since the amount owed will decrease as payments are made. Credit life is usually written on a group basis. There are tax rules that affect the way life insurance policy premiums and proceeds are paid. Keep these basic tax-related items in mind. Premiums paid on life insurance are not tax-deductible. Death benefits paid to a named beneficiary are not taxed as income. Any interest earned on the death benefit will be taxable for the beneficiary.
Policy provisions. A life insurance policy is a contract between the insurer and the policy owner. Life insurance policies have standard provisions or clauses that identify and protect the rights of the policy owner. The ownership clause states that the policy owner has all the rights contained in the policy. The owner has the right to borrow or withdraw cash value, receive policy dividends, assign ownership, and decide how policy proceeds are to be paid. Usually, the policy owner and the insured are the same person, but when the policy owner is not the insured, this is called third-party ownership. The entire contract provision states that the policy and the application are included in the contract. It prevents the insurer from changing the contract or referring to any outside documents. Any modifications to the contract must be made in writing and signed by an executive officer of the company. The insuring clause is the insurer's promise to pay upon the death of the insured. Subject to the conditions contained in the policy, the insuring clause also specifies who is covered and who will receive the death benefit. The consideration clause states that each party to the contract must exchange something of value. The policy owner's consideration is the statements in the application and the premium. The insurer's consideration is the promise to pay the benefits. The free look provision allows the policy owner the right to return the policy and receive a full refund of premium for a specified time, usually 10 days from the policy delivery date. The policy owner has the right to designate beneficiaries to receive the policy proceeds in the event of the death of the insured. In most cases, individuals are selected as beneficiaries, but businesses, trusts, estates, and charities may also be named. The primary beneficiary will receive the proceeds when the insured dies. If the primary beneficiary dies before the insured, then the secondary beneficiary will receive the proceeds. All beneficiaries named after the primary beneficiary are called contingent beneficiaries. Beneficiaries may be designated as revocable or irrevocable. A revocable beneficiary can be changed at the owner's request. An irrevocable beneficiary cannot be changed without the irrevocable beneficiary's signature. Minor children may be designated as beneficiaries, but they cannot legally sign for the insurance proceeds, so a parent, guardian, or trust will have to receive the proceeds on their behalf. The common disaster provision provides that if the insured and the sole beneficiary die from a common accident, the beneficiary must outlive the insured by a state-specified period of time, usually 30 to 90 days, in order to receive the proceeds. If the sole beneficiary dies within the specified period of time, the death benefit will be paid to the estate of the insured. The premium payment provision specifies that all premiums are paid in advance. If the premiums are not paid, the policy will lapse. The grace period provision prevents the policy from lapsing because of a late premium payment and allows the policy owner at least 30 or 31 days beyond the premium due date to submit the premium. The automatic premium loan provision may be added to a cash value policy. It gives the insurance company permission to take a policy loan against the cash value to pay the past due premiums to prevent an unintentional lapse of the policy after the grace period. The reinstatement provision allows the policy to be placed back in force if the policy is lapsed for 3 years or less. 3 things are required to reinstate a policy. The insured must pay all past due premiums. The insured must pay any outstanding loan plus interest. And the insured must prove insurability. Once the policy is reinstated, the incontestability period begins again for any questions on the reinstatement application. The policy loan provision gives the policy owner the right to borrow up to the amount of the cash value without surrendering or canceling the policy, and that cash value must be available after 3 years from issue date. The insurer has the right to defer loans for up to 6 months. Policy loans are not taxable. The incontestability clause limits the amount of time, usually 2 years, that an insurer can void a policy or contest a claim based on statements on the application. The assignment provision allows the policy owner to legally transfer ownership of the policy to another party. An absolute assignment is a permanent transfer of ownership. A collateral assignment is a temporary transfer of ownership and is often used to guarantee a loan. The misstatement of age or gender provision allows the company to adjust the death benefit after discovery of the misstatement to make it right. The provision is not restricted by the 2-year incontestability clause. Exclusions specify risks that will not be covered. The standard types of exclusions are aviation, hazardous hobbies, war, and commitment of a felony. The suicide clause excludes the payment of the death benefit if the insured commits suicide within the first 2 years of the policy. All premiums paid are returned. If the policy has been in force for 2 years or more, then the insurer must pay the full death benefit to the beneficiary.
Policy options. Policy options are choices on how to receive sums of money. There are 3 types of policy options: non-forfeiture options, dividend options, and settlement options. Non-forfeiture options are choices on how to use the cash value in a policy. By law, the policy owner cannot forfeit the cash value and has a right to choose from 3 non-forfeiture options when there is cash available. The 3 non-forfeiture options are cash, extended term, and reduced paid-up insurance. The cash surrender option allows the policy owner to cancel the policy and request the cash value in a lump sum. The lump sum payment will be reduced if there is a surrender charge or an outstanding loan. The extended term option allows the exchange of the cash value for a paid-up term policy of the same face amount as the original policy, but the coverage lasts for a shorter period of time, which is determined by the amount of cash value when the policy is exchanged. The reduced paid-up insurance option allows the exchange of the cash value for a single premium whole life policy with a reduced face amount that provides the same length of coverage until death or age 100, whichever occurs first. Dividends options are available when mutual companies issue participating policies. Participating policies pay policy dividends to the policy owner. Policy dividends are a return of an overpayment of premiums and are not taxable. Dividends are not guaranteed since they are dependent on the company meeting their financial obligations and are only issued when there are excess premiums. There are 6 dividend options. The first dividend option is cash. The company will pay the dividend to the policy owner in the form of a check. The second option is reduction of premium. The company will apply the dividend to the policy owner's next premium, which will reduce the amount of the premium payment. For example, if the annual premium is $600 and the dividend is $300, the insurer will apply the $300 to the premiums, and the policy owner will pay $300 out of pocket for the next annual premium. The third option is accumulate at interest. The dividends are left with the company and earn interest. Remember, the dividend is not taxable, but interest received with the accumulated interest option is taxable. The fourth option is paid-up additions. The dividend is used as a single premium to purchase fully paid-up additional insurance of the same kind of insurance as the original policy. The fifth option is paid-up life. This option uses the policy dividend to shorten the payment period of a limited pay policy. For example, a participating 20-pay life policy could be paid up in 15 years by applying the dividend as an additional payment towards the premium for the policy. The sixth option is 1-year term. The policy owner uses the dividend as a single premium to purchase 1 year of term insurance. This option is used most frequently to cover an outstanding policy loan in case the insured dies before the loan is paid in full. If the insured should die with an outstanding loan, the death benefit paid to the beneficiary would be reduced by the amount of the loan. Finally, settlement options are choices that the policy owner makes on how a death benefit should be paid to the beneficiary. If the policy owner fails to choose a settlement option prior to the death of the insured, the beneficiary will select the settlement option. There are 5 settlement options: cash, interest only, fixed period, fixed amount, and life income. With the cash or lump sum option, the beneficiary will receive the total death benefit in a one-time payment. With the interest-only option, the proceeds are held by the insurer and earn interest. The interest must be paid at least annually. The death benefit is not taxable to the beneficiary, but any interest earned on the death benefit is taxable. The interest-only option is usually a temporary settlement option to allow the beneficiary time to consider how to use the death benefit. The beneficiary can request the payment of the full death benefit or a portion of the death benefit at any time. The fixed period option will make payments to the beneficiary for a specified length of time. The company determines the amount for each distribution, which includes principal and interest. The payment amount will vary depending on the interest earned, so the total amount is distributed in the specified period of time. The fixed amount option will make payment of the same amount to the beneficiary, and the length of time will vary depending on the interest earned until the total amount is distributed. The fifth settlement option is the life income option, which provides a lifetime income to the beneficiary. This option will be discussed further in the annuities section.
Policy writers. Policy writers customize a policy by adding features, usually for an additional cost, so the premium payment would be higher. Policy writers are attached to and made part of the policy contract. The first group of policy writers is the waiver of premium rider, the payer benefit rider, and the accidental death rider. The waiver of premium rider provides that if the insured becomes totally disabled, the company will waive the premiums for as long as the disability continues. There is a 6-month waiting period before premiums are waived to make sure the disability is total. If the disability continues after the 6-month waiting period, the insurer will refund the premiums that were paid during the 6-month waiting period, and then waive future premiums for as long as the insured continues to be totally disabled. All features of the policy will continue while the insurer waives the premium. The waiver of premium with disability income rider waives the premiums and pays a specified monthly income while the insured is totally disabled. With the payer benefit rider, the insurer will waive the premium on a juvenile policy if the payer dies or becomes totally disabled. The payer is the policy owner, usually a parent or guardian. The juvenile insured will start making the premium payments when a predetermined age that is specified in the rider is reached, such as 18, 21, or 25. The accidental death rider is also called a double indemnity or multiple indemnity rider. Double indemnity means the insurer will pay twice the face amount of the policy if the insured dies in an accident. Death must occur within 90 days of the accident, and the accident must be the sole cause of death. The insurer will only pay the face amount of the policy to the beneficiary if the insured should die from any other cause than the accident. For example, if an insured should be driving a car on a highway, have a heart attack which results in an automobile accident, and the insured dies, the insurer will only pay the face amount of the policy to the beneficiary. Death of the insured was caused from the heart attack, which is an illness, not an accident. The last group of riders is the guaranteed insurability rider, the cost of living rider, and the accelerated death benefit rider. The guaranteed insurability rider allows the policy owner to purchase additional insurance in an amount specified in the policy at specific dates, ages, or events such as marriage, birth, or adoption of a child without submitting new proof of insurability. The cost of living adjustment rider, COLA, allows the policy owner to add a specific amount of insurance coverage to the policy each year to keep pace with inflation. The accelerated death benefit rider, also called the living benefit rider, is designed to pay a portion of the face amount to the insured during the insured's lifetime. This rider requires a qualifying event for the payment to be made. The qualifying event may be the insured has been diagnosed with a terminal illness, the insured has been diagnosed with a dread disease listed on the rider, or the insured has been permanently confined to a nursing home.
Annuities. Annuities are not life insurance. They are retirement plans sold by life insurance companies. Annuities can be used to save for retirement on a tax-deferred basis, which means no income tax is due on the earned interest until the money is withdrawn. Annuities are used to systematically liquidate an estate, which means to withdraw funds over a person's lifetime. The annuitant is the person who receives the benefits from the annuity, and the benefit payments are based on the annuitant's life expectancy. An annuity can best be described as having two distinct periods, an accumulation period and an annuity period. The accumulation period, or the pay-in period, takes place when the premium is being paid into the annuity. This period lasts from the purchase of the annuity until the benefit payments begin. The annuity period is the payout period. It is the period of time when the money is withdrawn from the annuity. It may also be called the benefit period. Annuities may be purchased in a variety of ways. A single premium annuity is purchased with a lump sum. Annuities may also be purchased in installments on a periodic basis. A level premium annuity is a fixed premium payment paid at the same frequency, such as monthly or quarterly. Most annuities are flexible premium annuities, which means that the owner may increase, decrease, or skip premium payments. Annuities are also classified according to when the benefit payments begin. An immediate annuity is purchased with a single premium, and the payout begins within 12 months of purchase. A deferred annuity can be purchased with either a single premium, level premium, or flexible premium. The payout begins 12 months after purchase or later. There are several types of annuities. A fixed annuity has a guaranteed minimum interest rate during the accumulation period, as well as a guaranteed benefit amount during the payout phase. A variable annuity does not have a guaranteed rate of return, since the money is invested in securities such as stocks, bonds, or mutual funds, and must be deposited into the insurance company's separate account. Variable means the value of the annuity will fluctuate with the underlying investments in the separate account. Both a life insurance license and a securities license are required to sell variable annuities. An equity-indexed annuity has a guaranteed minimum interest rate, but may earn a better rate of return based on a specific index, such as the S&P 500. Only a life insurance license is required to sell an equity-indexed annuity. There are several ways in which the benefits of an annuity may be paid out. The first is during the accumulation period. At any time during the accumulation period, the annuity owner may surrender the annuity contract and receive the cash, less any surrender charges, which are early withdrawal fees charged by the insurance company. The surrender charge decreases the longer the annuity is held by the insurer before surrendering the annuity. Taxes will have to be paid when monies are withdrawn or the annuity is surrendered. Monies grow tax deferred, which means there is no tax on the interest until the money is withdrawn. The monies are returned based on a last-in, first-out basis known as LIFO. So interest is assumed to be added last, and it is withdrawn first and taxed accordingly. Once the annuity has annuitized or reached the period where it will begin making payouts, there are several ways the money may be paid. The fixed period settlement option provides benefit payments only for a specified period of time. The fixed amount settlement option provides for a specified benefit amount until the money is depleted. The fixed period or the fixed amount options do not provide a guaranteed life income for the annuitant. Annuitants may also choose to receive guaranteed income for the rest of their lives from their annuities. The first life income option is straight life, also known as pure life. This option guarantees payment of annuity benefits for the life of the annuitant, but payments stop when the annuitant dies. The straight life or pure life option provides the largest monthly income to the annuitant. The second life income option is known as life with period certain. This option guarantees the payment of annuity benefits for the life of the annuitant, but it also provides an extra guarantee for a certain period of time. If the annuitant dies during the guaranteed period of time, payments will continue to the beneficiary for the time remaining in the period certain. For example, in a life with 10-year period certain annuity, if the annuitant dies after receiving 6 years of benefit payments, the beneficiary will receive the remaining 4 years of payments. The third life income option is known as a refund life option. This also guarantees a lifetime income, but if the annuitant dies before the entire principal is paid out, the beneficiary can receive the balance of the annuity either in a single lump sum payment or installment payments. An annuity may cover the lives of more than one annuitant. A joint life annuity covers the lives of 2 or more annuitants, and the benefit payments stop on the death of the first annuitant. A joint and survivorship life annuity covers the lives of 2 or more annuitants, and the benefit payments stop on the death of the last Annuitant.
Retirement plans. Retirement plans serve many purposes for individuals, employees, and employers, including having substantial tax advantages. These plans are designed for and may be set up by individuals, companies, federal and state governments, and nonprofit organizations. There are some basic tax terms that will help in understanding retirement plans. Tax deferred means the interest earned within the retirement plan will not be taxed until the money is taken out. Taking money out of the plan is referred to as a distribution or withdrawal from the plan. Tax deductible means the money put into the plan by the individual or the company is not included as taxable income and will reduce the taxes owed to the Internal Revenue Service. Money put into the plan is referred to as a contribution. Taxable means that the money is considered income and will be taxed. There are two main classifications of retirement plans: qualified plans and non-qualified plans. There are several types of qualified plans, but each type is regulated by the federal government in order to receive favorable tax treatment. The requirements for a qualified plan are: a qualified plan must meet certain IRS requirements to receive special tax treatment. The plan must be for the exclusive benefit of the employees and their beneficiaries. The employees' contributions belong to the employees. They have the right to name their beneficiaries to receive the money in the fund if they should die. The plan must be communicated to the employees in writing. The plan cannot discriminate between employees of the same class. It must include all employees and not favor those who are highly paid employees over those who are lower paid. The plan must be permanent. It cannot be set up on a temporary basis nor have gaps in coverage. The plan must have a vesting schedule, which specifies when and how much of the employer's contributions the employee will be entitled to receive if the employee leaves the company. All qualified retirement plans must be either defined contribution, which specify a predetermined amount to be put in the plan, or defined benefit, which pay out a specified amount at retirement. The tax advantages of a qualified plan include: the employer's and the employee's contributions are not taxed as current income to the employee. The employer's contributions are tax deductible to the company. Earnings of the plan grow tax deferred. If an employee takes on an early distribution from a qualified plan prior to age 59 and a half, the distribution will be taxed, and there will be a 10% penalty unless the early distribution was for one of the following exceptions: medical expenses, purchase of a first home, qualified higher education expenses, death or permanent disability to the participant, a divorce decree that states the funds must be split with the spouse, a series of periodic payments under a life annuity arrangement. The first type of qualified plans is individual retirement accounts, or IRAs. There are two types of IRAs: the traditional IRA, often referred to just as an IRA, and the Roth IRA. The traditional IRA allows an individual to contribute tax-deductible contributions toward retirement. The annual contribution to a traditional IRA is limited to 100% of earned income, or the IRS specified maximum limit, whichever is less. Earned income includes all taxable income and wages received for working. In most cases, the contributions to a traditional IRA are tax deductible, but there is a 6% penalty for excess contributions above the IRS annual limits. The contributions and interest earned accumulate tax deferred. Distributions from a traditional IRA are taxable. Distributions from a traditional IRA must begin by age 70 and a half. There will be a 50% penalty on the amount of any required distribution that is not withdrawn from the plan beginning at 70 and a half. With a Roth IRA, contributions are not tax deductible, but distributions are received tax-free. The annual contribution to a Roth IRA is also limited to 100% of earned income, or the IRS specified maximum limit, whichever is less. There is a 6% penalty for excess contributions above the IRS annual limits. There is no age limit for setting up and contributing to a Roth IRA. distributions are not required to begin at any certain age. If distributions are taken, which would include both contributions and interest earned, the distributions are tax-free at age 59 and a half, and the plan has been open for at least 5 years. The second type of qualified plans is for small employers. These include KEO, SEP, and Simple plans. An HR 10, also known as a KEO, is for unincorporated self-employed individuals. A simplified employee pension plan, also referred to as a SEP, is an IRA that is set up for eligible employees. The employer makes the contributions, which are tax-deductible to the company. A savings incentive match plan for employees, called a Simple, is also an employee IRA, but unlike the SEP, the employee makes the contributions and the employer matches with tax-deductible contributions. To qualify for a Simple, the employer cannot have more than 100 employees. The third type of qualified plans is for large employers. They are 401k, profit sharing, and TSA 403B plans. The 401k is referred to as a salary reduction plan because the employee contributes on a tax-deductible basis. The employee chooses the amount to contribute within IRS limits, and the contribution is not included in taxable wages. Any matching contribution by the employer is tax-deductible to the business and is not included in that year's taxable income to the employee. The employee's account grows tax-deferred and distributions are taxable. A profit-sharing plan is the most flexible of the qualified large employer plans. Tax-deductible contributions are only required to be paid by the company in years the business shows a profit. However, contributions must be regular and substantial to keep the designation as a qualified plan by the IRS. Contributions grow tax-deferred and distributions are taxable. The TSA 403B, or tax-sheltered annuity, is similar to the 401k, but is used by not-for-profit organizations such as churches, hospitals, public schools, and other 501c3 not-for-profit organizations. Contributions grow tax-deferred, and all distributions are taxable. Non-qualified plans do not meet the requirements set forth by the IRS. Their characteristics are the opposite of qualified plans in many ways. They do not receive IRS favorable tax treatment. An employer can discriminate by picking and choosing which employees are eligible for the plan. Contributions are not tax-deductible. There are no limits on contributions. Examples of non-qualified plans include individual annuities, deferred compensation plans, executive bonus plans, and split dollar plans.
Marketing practices, unfair trade practices. A marketing practice describes how insurance companies and agents sell insurance to the public. Marketing practices are regulated by the state departments of insurance to ensure that there is no unethical behavior between insurers and agents when dealing with consumers. This ensures that all persons in the insurance industry are being truthful and treating all applicants, agents, and insurers fairly. When there is unethical behavior, it is usually called an unfair marketing practice, but may also be called an unfair trade practice or an unfair insurance practice. Engaging in an unfair marketing practice may result in the state imposing a fine per each violation, such as a set dollar amount. In addition to a fine, an agent's license or an insurer's certificate of authority could be suspended, revoked, or denied. Suspension is a temporary loss of license. Revoked is a permanent loss of license. Denied is a refusal to issue or reissue a license. There are several types of unfair trade practices, each with specific characteristics. Boycott, coercion, and intimidation are acts that are intended to restrict fair trade and create a monopoly in the transaction of insurance. Boycott means to refuse to have dealings with a person or organization, or refuse to buy a product as a protest or means of coercion. Coercion is the practice of forcing another party to act against their will, usually through threats or intimidation. Intimidation is to force someone into an action or stop them from an action by causing fear. A misrepresentation is a lie and includes any false, misleading, or deceptive statement made by an insurer or agent about the terms, advantages, or benefits of a policy. An example of misrepresentation would be an agent telling a client that the policy is a participating policy and it always pays an annual dividend. The truth is that participating policies do pay dividends, but the dividends are not guaranteed to be paid every year. Defamation is making statements either orally or in writing which are personally or financially harmful to an insurer or agent. An example of defamation would be an agent telling a client, "Do not purchase insurance from that agent because I heard he was a liar," or "Do not purchase insurance from that company because they are running out of money." Twisting occurs when an agent misrepresents policy information to persuade an insured or owner to cancel, lapse, or switch policies, even when it's not in his or her best interest. Illegal inducement is offering an applicant anything of value that is not stated in the policy. For example, an agent cannot offer an applicant season tickets to a professional football game for signing a life insurance application. Rebating is paying, offering, or giving anything of value not listed in the policy to a person as inducement to purchase a life insurance policy. Rebating may include commissions, premiums, personal services, or other items of value. Discrimination between individuals of the same rate class is a violation. No discrimination is allowed on the basis of marital status, race, religion, national origin, or place of residence between individuals of the same insurance risk with regard to policy provisions such as premiums, benefits, or other terms. False or deceptive advertising is making a statement, either written or oral, about the insurance business or any person engaged in the insurance business that is untrue, deceptive, or misleading. One example would be to advertise insurance products that an insurer or agent will not or cannot sell. An insurer cannot advertise that a policy it sells will pay a dividend to the policy owner if the insured is not a mutual insurer. Advertising of the Guarantee Association is also an unfair trade practice. The Guarantee Association protects policy owners, insureds, and beneficiaries in case an insurer should become financially impaired, meaning the company is running out of money or insolvent. Insurers doing business in a state must be members of the association and pay fees to cover the Guarantee Association's expenses. Insurers and agents cannot use the existence of the Guarantee Association in their advertising. For example, an agent cannot tell a client that the insurer he represents is a member of the Guarantee Association, so it is safe and highly recommended that the client purchase insurance from this insurer. Making false financial statements to a public official or circulating false financial information about any person or insurer's financial condition with the intent to deceive is a violation. For example, all financial reports filed with the state must be true and accurate.
Additional state-specific material. Some states have additional material that is covered on their state-specific outlines. Consult your state exam content outline to verify if the following terms are covered on your state exam. There are 5 ways of handling risk: sharing, transfer, avoidance, reduction, and retention. By sharing risk, the cost of the loss is spread among a group who share in the potential loss. Purchasing an insurance policy is an example of the transfer of risk. The policy owner pays a small premium in exchange for coverage for a potentially large financial loss. Avoidance means staying away from any situation where risk may be involved, such as never skydiving to avoid the risk of dying from it. In the case of reduction, by reducing the chance or potential for a risk to occur, the chance of loss can be lessened. Then, if the risk occurs, the loss would not be so drastic. Examples include having smoke detectors in your home or airbags in your car. Self-insurance is the retention of some portion of all of the risk. This is basically having no insurance and retaining the risk. 3 types of authority that the agent has to transact business are express, implied, and apparent. Expressed authority is the written authority granted in the contract between an agent and an insurance company that tells an agent what he or she can and cannot do. Implied authority is not expressly granted under an agency contract. It is the authority an agent must have to conduct general business practices, such as ordering a medical exam for a proposed insured. Apparent authority is the authority an agent seems to have because of certain actions by the agent, such as using business cards or insurance rate books. Apparent authority concerns the relationship between an agent and an applicant and should not be used to mislead the applicant. All life insurance policies are contracts. A contract is defined as an agreement between 2 or more individuals or parties. There are 4 elements that are required for a contract to be legally enforceable: offer and acceptance, consideration, legal capacity, and legal purpose. An offer is made when an applicant completes and signs the application and submits the first premium payment. Acceptance is when the insurer approves the application and issues the policy. When there is both an offer and acceptance, it is referred to as an agreement. Consideration is defined as something of value, such as money or promises. Consideration must be given by both parties of the contract. The applicant's consideration consists of the statements in the application and payment of the first premium. The company's consideration is the promise to pay the benefits contained in the policy if the insured dies during the contract period. Legal capacity or competent parties means that the parties to the contract must be of legal age, sane, not under the influence of drugs or alcohol, and not being forced. The final element of a contract is legal purpose. The purpose of a contract itself must be legal and not against public policy. Insurance contracts have 3 unique legal characteristics: adhesion, aleatory, and unilateral. In a contract of adhesion, the insurance company wrote the policy and the applicant cannot change the wording of the contract. The courts have ruled if the wording of the policy is vague or unclear, any issues will be resolved in favor of the policy owner. An aleatory contract has an unequal exchange of value between the policy owner and the insurer. The policy owner could pay a premium for the length of the policy and the insured does not die, so the insurer never has to pay the death benefit. On the other hand, a policy owner could make one premium payment, the insured dies, and the insurer would have to pay the death benefit to the beneficiary. Unilateral means one-sided. Only one party, the insurance company, makes an enforceable promise. The insurer promises to pay the benefits if the policy owner pays the required premium. However, the policy owner does not promise to pay the premium and can surrender the policy at any time. There are several other legal terms used in the insurance industry. Utmost good faith is an insurance principle which states that all involved parties to the contract are relying on each other to be honest and to act in good faith, and that all parties want the contract to work. Fraud is a lie for financial gain and is an act of deception. Fraud occurs when there is cheating by someone in order to financially benefit at the expense of others. A waiver is the intentional and voluntary giving up of a known right or privilege, such as the insurer waiving their right to collect premiums if an insured becomes disabled, and the policy had a waiver of premium rider. Estoppel is the legal consequence of a waiver. This principle states that one party to a contract may be stopped by its past words or actions from asserting a right granted in the contract. In other words, once a right is waived, it may not later be enforced. Liquidity means that something is easily convertible to cash. For example, a policy loan from a cash value life insurance policy may be received in a short period of time, whereas the sale of a home may take several months or longer. There are two methods that can be used to calculate how much life insurance coverage an applicant requires: the human life value approach and the needs approach. The human life value approach focuses on the earning potential of the insured projected over a lifetime. It is used to calculate how much money would be needed to replace the lost earnings of the insured if he or she dies an early death. The needs approach focuses on the needs of the survivors of the insured at the time of death. It considers such things as funeral expenses, income for a spouse or children, a mortgage, education funds for the children, and other debts. Life insurance may also be used for business purposes. A buy-sell agreement is a legal document which outlines the continuation of a business in the event of the death of a business partner. It states who can buy a deceased partner's share of the business and how the value of the deceased partner's share will be calculated. Life insurance policies can be used to fund the buy-sell agreement by providing life insurance proceeds to pay for the deceased partner's interest in the business. Key person life insurance is often used to protect a business from the death of an important person, such as the owner, director, executive, or manager. The business is the applicant, the owner, the beneficiary, and the party responsible for the payment of the premium. The key person must give consent by signing the application. Once the risk classification has been determined for a new policy, the premium amount can be calculated. There are three factors that insurance companies consider when determining premium rates: mortality, interest, and expense. Mortality is the expected number of deaths for people of a specific age each year. These mortality rates are used to create mortality tables, which the insurer uses to calculate the cost of providing death protection for its insureds. The interest earned by the insurer is also calculated into the premium rates. The insurer invests the premiums paid by the policy owner and uses the interest earned to reduce the company's costs and therefore reduce the premium rate. Expenses, often referred to as loading, are the cost of doing business. These include the cost of running the company, paying employee salaries and agent commissions, and paying local, state, and federal taxes. Life insurance policies are sometimes referred to as having living benefits that financially aid the insured while still living. Policies may sometimes be sold to a third party where an insured has been diagnosed with a terminal or chronic illness and needs to obtain funds for needed medical care. A viatical settlement is an agreement to sell the policy to a third party called the viatical settlement provider. The seller of the policy is known as the viator and is the terminally ill or chronically ill insured. The viator receives a portion of the face amount prior to the insured's death, and the viatical settlement provider becomes the owner of the policy and will receive the full death benefit of the policy upon the death of the insured. Policies may sometimes be backdated to a date earlier than the application date by up to 6 months to preserve the current age of the proposed insured. The result is a lower premium for the policy owner by allowing the company to consider the insured a year younger. When the policy is issued and delivered, the agent must collect premiums for each month the application was backdated. At the time of policy delivery, the producer may present the insured with a policy illustration. Policy illustrations contain future projections and performance of the cash values beyond the guaranteed minimum stated in the policy. Illustrations are often used in sales presentations. Illustrations are not guaranteed and must be approved by the insurance company. A copy of any illustration used in the sale of an insurance policy must be left with the applicant. Illustrations are not part of the contract.